Hey everyone, and thanks for jumping back into the cryptoverse. Today, we're going to talk about Bitcoin and Ethereum and investigate ways that you can balance your portfolio based on historical data. If you guys like the content, please subscribe to the channel, give the video a thumbs up, and also check out the Telegram channel, which you can find a link to in the description below. So the purpose of this video is, whenever the markets start flying and Bitcoin goes up and Ethereum goes up and the markets start moving up, everyone will put out rate my portfolio type posts. And they'll want to say, okay, well, what is a good portfolio to have based on percentages? And they will seek the advice of random people on the internet to give them some validity as to are they making a good choice. Well, my argument is that there's a much better way to do it. Don't listen to people's opinions about things, is my philosophy. Stick with the data, right? Stick with the data. What does the data tell you? And go with that, because to me, that's much more important than what any one specific person necessarily thinks. Everything's usually hidden, or maybe not so hidden, within the data. So what we're going to talk about here is something we've talked about on the channel before. It has been a while though. This is modern portfolio theory, quantitative finance. This is what a lot of people use in traditional banking and investing. So what it is, we're plotting here only Bitcoin and Ethereum. We're plotting the expected return versus the volatility. Now, the expected return is the return that we would expect annually based off nothing more than historical data. It is not projected returns. Projected returns are often this secret sauce that hedge funds might use to try to figure out what investments they're going to take. So that's another step, putting in projected returns. This is just historical returns starting from 2015. You might say, well, why don't you go back further? Well, Ethereum launched in 2015, and in order for this to make any sense at all, you need to use the same time date, the same time series. You can't use data for Bitcoin going back to 2010 and Ether data going back to 2015. It wouldn't really make a whole lot of sense in terms of your covariance matrix and a few other things. So you have to use it the same amount of time, same amount of days. So the expected return, one would be 100%. And you might say, well, hold up a second. You mean to say that I can expect 100% return? I'm not saying that. That's what the data says, right? That's what the data says, is that you can expect a 100% return annually on average. Of course, there's going to be some years where you would see an 80% drop. There might be some years where you see a 300% return or something like that. If you think about it, the price of Bitcoin from the beginning of the year is up several 100%. So just historical data, expected return, annual expected return. So 1 would be 100%, 1.1, 110%. Volatility is also the risk in a sense. So if you want to think about the risk that you're taking on, you can think of it in terms of the volatility. This would be 90% volatility, 80%, 70% volatility. What the hell does that mean, right? Well, what it means is if you say had this yellow portfolio, it means that your expected return would be 95% to within one standard deviation. So your expected return would be 95% plus or minus 65%. And the return on that would come within one standard deviation, so 68% probability that your annual return by holding this percentage of Bitcoin and Ethereum, we'll get to that in a minute, would yield a 95% return plus or minus 65%. So the lower bound on that would be 30%, 95 minus 65, so your expected annual return. Lower bound would be 30% because we know volatility is 65%, and then the upper bound would be 95 plus 65. So that would be, if we 160%, right? So just something to keep in mind. So within one standard deviation, a 68% probability that your expected return would be between 30% and 160%. That's a huge range. It's not as bad. It's not as drastic in a lot of other markets. But it's crypto, and it's why we're here. So what's going on here? These are 10 dots, okay? And they're color-coded by the Sharpe ratio. So these are your risk-adjusted returns, okay? I forgot to put the equation on the slideshow, but the Sharpe ratio is very well known in quantitative finance, as modern portfolio theory. A lot of great papers written on the Sharpe ratio. So it's your risk-adjusted returns. I've said before many times, it's not about your return, it's about your risk-adjusted return, right? I mean, think about it like this. Would you rather have like a 50% chance of making 5x or a 5% chance of making 10x or something like that? I think most people would choose, say, 50% chance to make 5x because the odds are a lot higher and you're still making a lot of money. Yes, being very risky in your investments could theoretically yield you a higher return, but there's many scenarios where it wouldn't. If you think about it, if we live in a multiverse and there's several other identical universes that have variations on what actually happens in each specific one, if you invest a lot of money into some random altcoin that someone showed you on Twitter, there's so many different scenarios where that does not go well. Okay, there's some where it does, and a lot of people can get rich doing it, but a lot of people bet the family farm and lose it on highly speculative assets. And to some degree, Bitcoin and Ethereum are highly speculative already. So getting too far down into the mud with a lot of other coins does carry a lot of risk. So you're probably wondering, what is this, right? There's 10 dots. Well, let's increase it. Let's go to say 100 and 1,000 and 10,000 and 100,000 simulations. So Monte Carlo approach, a brute force, figuring out which portfolio gives you the best risk-adjusted returns, or the Sharpe ratio, out of combinations of only Bitcoin and Ethereum. So only looking at Bitcoin and Ethereum, out of all the different portfolio weightings, what would give you the best risk-adjusted return? And you can do it by brute force. Monte Carlo is simulation where you just look at 100,000 different ones. You could even go higher. And it turns out that you can also solve for it, right? A bit of quadratic programming in Python, simple enough, right? Piece of cake, solve for it, figure out, what is the most optimal portfolio. So, based on, and the thing I love about this is that it does not matter what my opinion is, right? My opinion could be one thing, the data could say another. And so if you don't like the results of this, don't take it up with me, take it up with the data, right? I've said that before about other projects, right? We've looked at this type of analysis with random altcoins before, and it suggests 0% of that coin in your portfolio based on its historical returns and historical volatility. And that tends to rub people the wrong way because it might be insulting, one of their projects that they like to follow. And my response is, don't take it up with me, just take it up with the data, because the data is telling me what I need to know, not my emotions, not any fundamental factors, not, but the community, it's all about the community and this community is so much better, blah, 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 right? Again, as I said, no one cares about that stuff. This channel, we're here to make money. That's my goal. But we want to do it in the least risky way possible and not concern. I don't really want to concern myself with how healthy a specific community is. Show me the data, we'll show you the portfolio. So, the portfolio of Bitcoin and Ethereum, which maximizes your Sharpe ratio or your risk-adjusted returns based on historical volatility and historical returns from 2015, is 74.4% Bitcoin, 25.6% Ethereum. Okay? Simple as that. Looking at historical data, historical volatility, returns, etc., that's the portfolio which maximizes your Sharpe ratio. Meaning, this star is the optimal portfolio on the efficient frontier. This is known as the efficient frontier. You can maybe refer to this down here as the inefficient frontier, because you're taking on the same amount of risk for a lower expected return. Okay? And it looks different with only 2 coins than it would with 3. We'll show you what 3 coins looks like in a minute. So 74.4% Bitcoin, 25.6% Ethereum. This changes over time. I think about a year ago, it was suggesting 60-40, 60% Bitcoin, 40% Ethereum. So one way to navigate the markets is just to rerun this analysis every month or two and reweight it, right? Reweight it. And that doesn't mean you need to sell Bitcoin to Ethereum or sell Ethereum to Bitcoin, but maybe if you're focused on accumulating, you could use this type of analysis to figure out which one to continue accumulating to get to that ideal percentage. Again, this is not financial advice. This is just looking at historical data, looking at very specific measurements, using modern portfolio theory and presenting the results. Okay? Now, some of you are probably wondering, what if we throw risk out the window? Like, who does this guy think he is telling me he knows what my risk tolerance should be? And that's a fair point, because everyone has a different risk tolerance. If you're young and in your 20s, you might have a larger risk appetite than someone who's nearing retirement. Someone who's nearing retirement, they might want exposure to crypto, but they also want to do it in a very smart and as risk averse as they can, because they don't want to watch a lot of their savings go up and then come straight back down. So what they want to do is be more risk averse. If you're younger, perhaps you could be riskier. I prefer to be more risk averse, just because I've lived through crypto bear markets, and I can tell you it's not fun. It's not fun if you're on the wrong side of that. And so I prefer to be more risk averse, and there's times like this, the last few months, where holding a majority of Bitcoin was the right thing to do in hindsight. I mean, of course, Ethereum has had a better year overall, but there's certainly phases of it where Bitcoin outperforms. And whenever Bitcoin gives the slight hint that it's going to drop, Ether drops more. I'm a big proponent of Ethereum. I love holding Ethereum. I expect to have higher returns from Ethereum, but I'm paying for it with higher levels of risk or volatility. So you're probably wondering, what if I throw risk out the window? You're also probably wondering why he's been putting an emoji in his presentation. Well, I don't really have a good answer for that. So the question then becomes, well, what if we pick a portfolio above this, say, this line through it right here? So it was a circle, it's not quite showing up. But what if we pick a portfolio all the way over here at the very top, meaning maybe our expected return is higher, but we're paying for it with a lot more risk. So in this scenario, maybe your expected return is around, let's say, 120%. Volatility is at 105. So to within one standard deviation, or 68%, your expected return might be 120 plus or minus 105. So all the way down to 15% at the bottom, or 235% at the top. So theoretically, a higher expected return, you're taking a lot more risk on, and it's possible you end up seeing a lower risk or a lower return. Again, it's not saying that your return at the least will be 15%. It's just saying that to within one standard deviation, or a 68% probability, that is where your return would be. Of course, there's going to be some years where you would experience a loss. That's obvious, okay? Now, you also might be wondering, well, what if I want less risk, but I want to take on more risk than what maximizes the Sharpe ratio? Because this is what maximizes the Sharpe ratio. This would be the least risky portfolio in terms of maximizing your risk-adjusted returns. So what if you go somewhere in this ballpark and you say you want to take on 80% volatility? In that scenario, the portfolio, which maximizes your Sharpe ratio on the efficient frontier, would actually be 35% Bitcoin, 65% Ethereum. So theoretically, you would expect a higher return. You're paying for it with more units of risk. Okay? If you're trying to figure out ways to get higher returns, usually there's going to be some higher level of risk associated with it. And you can see that in the volatility. So what if you are very inefficient with your portfolio and you decide, you know what, I want to be on the inefficient frontier? I can't explain why someone would want to be, because you're taking on the same level of risk for a theoretically lower expected return. But again, you do you. For instance, let's say you wanted to be all the way down here. it would imply 90% Bitcoin, 10% Ethereum. So the reason why this gives you a lower Sharpe ratio is because you're not really holding a lot of Ethereum. And Ethereum tends to outperform Bitcoin. It does it in a manner that is more risky because the volatility is higher to the upside and the downside, but there's a certain level where it balances out and it maximizes your Sharpe ratio, and it's over here. If you're going to be all the way down here at the same risk level, more or less, but have a lower expected return, then in my opinion, right, you're doing something wrong. And the best part about it is it's not even my opinion, it's what the data says. And that's what we want to focus on. You know, I get a lot of people that like to criticize some of the stuff I present, whether it be diminishing returns, that type of stuff. And my general response to all of this is, it's not like this is just what I feel is going to happen based on my own emotions that morning. It's just what the data suggests, and that's what I like to stick to. Just stick to the data. If it turns out that something drastically different happens, then so be it, but it doesn't change the fact that I'm going to stick to the data and go with the data as long as I can, and just stick with that. I think it tends to work out better than just, you know, going off however you feel that day. So what if we had a third coin? Okay, this is 2 coins. When you have 2 coins, you just get a pretty simple line. What if you had a third coin? Looks different now. So this, you can clearly see, this is your efficient frontier, okay? All the way up here. Below this point, I would call it your inefficient frontier, because, you know, let's say you pick a portfolio which lines up on this level, and it gives you an expected return of 70% with 80% volatility. That means your expected return could be as low as negative 10%, and that would have a 68% probability. I mean, it would be negative 10% all the way up to maybe like 150% or so, but there would be a 68% probability that would be your return. And so when you add a third coin, it changes the game, right? It creates this a different type of map here. It's not just a line over here. You get all these different portfolios. This is 100,000 portfolios, 100,000 different portfolio weightings. We simulated in Python, got the results, put them here for you guys to see. And this is what pisses people off. If you add Litecoin, 0%. Well, why is it 0%? Does it mean that Litecoin can't go up? No, it does not mean that Litecoin can't go up. If Bitcoin trends up, Litecoin will trend up too. I actually just picked up some Litecoin a couple weeks ago because, as I've said before, when Bitcoin gets to the prior all-time high, Litecoin does tend to do well. So in that scenario, there's different ways you can look at it, right? If you want to try to make key moves based on historical patterns, you can do that. I did pick up a little bit of Litecoin. However, as I've said before, there's a time to hold Litecoin and there's a time not to, and then like over 90% of the time, I think it's not to, based on historical returns and historical volatility. You can see the data doesn't lie. It suggests to maximize your Sharpe ratio. It's the same thing as if you just were choosing from Bitcoin and Ethereum. 74.4% Bitcoin, 25.6% Ethereum, 0.0% Litecoin. Now, this is subject to change. I've run this analysis in the past, and there's been phases where it might go up to, you know, a couple of percentage points or something. But generally speaking, it tends to be around 0. And the reason, again, is not because it can't go up. It's just that the downside risk in terms of its historical returns and historical volatility does not justify the upside potential. That's all it means. You also need to think of this in terms of the opportunity cost. Right? If you're putting $1 into Litecoin, that's $1 not going into Bitcoin, or that's $1 not going into Ethereum. So it's not. So essentially, the argument is that adding Litecoin to your portfolio does not improve your covariance matrix enough to justify the downside risk associated with it. That's all it means. Again, if you don't like it, take it up with the data, and if the price starts performing better and there's lower volatility and higher returns, then it'll start showing up. Right? Then it'll start showing up. But again, based on data from 2015, mixed in with Bitcoin and Ethereum data from 2015, it shows that Bitcoin and Ethereum yields the higher Sharpe ratio. But as we said before, if you wanted to take on more risk and come up here, there probably are some portfolios that have a little bit of Litecoin. As I said before, I just picked up a little bit of Litecoin not that long ago. sometimes based on other factors like where Bitcoin is within the market cycle, maybe it's okay to justify taking on a little bit more risk here on the efficient frontier. You're taking on more risk as you go up the volatility axis, but you're also going up the expected return axis as well. So you're saying, okay, I'm going to take on a little bit more risk. Hopefully it comes with a higher return. I get it. I'm out, back out of it, right? That's the idea. So hopefully this has been useful. We talk about modern portfolio theory on the public channel occasionally. We definitely talk about it on the premium list. We've had a few weekly reports on it. I'll probably try to jump more into it here over the next few weeks and months as people really try to gear up their portfolios for the bull market if we get one or a sustained one. Again, is it possible that the bull market is just 2021 one and done? It's possible. Do I think it's likely? No, I don't. And so I think it is important to think about these things because it could potentially be make a huge difference in a few years. Small portfolio tweaks can make huge differences. I mean, absolutely enormous differences later on. So if you guys like the content, subscribe. Let's go for 80,000 subscribers. We like to present information here that you probably won't find elsewhere. We also do have the premium list, the holiday sale. Make sure you check that out before the prices go up. They'll probably go up early January. I'll try to get you guys a specific date, but they're going to go up soon. Make sure you sign up. It's not going to last forever. And you get access to weekly reports, weekly videos, the Telegram alerts channel, the Telegram chat room, the risk dashboard, the trading view indicators. Next year, we're going to start doing premium list only live streams and a few other things that we have planned. So make sure you guys check it out and sign up before the prices go up. Hope you guys enjoyed the analysis. Subscribe, give the video a thumbs up, turn on notifications so you'll see future videos, and I'll see you next time. Bye.